Y'all, the US dollar could be in trouble, and I want to talk about what this means for the rest of the economy. Now, there are a few different troubles as to why people are starting to think that the US dollar is overvalued. One of the risks is that there are these tariff risks that cause inflation to happen. And when inflation happens, all right, I should probably use my dollars to buy assets because they might do a little bit better under inflation versus sitting it in a currency that loses value to inflation, right? So stocks, real estate, other assets tend to do better during these times. But there's another risk out there, and that is recession risk. And think about where this recession risk comes in and why it really matters to the dollar. So there are two parties, right? There are parties who use the US dollar, and that US dollar will have purchasing power. Well, wherever there's inflation, the purchasing power happens to go down. And when the economy starts slowing down from less demand, purchasing power goes down. That slows the economy. Then pricing power for businesses also goes down because now companies aren't making as much margin, making as much money than they were during that time, unless they're really able to cut costs. And there's really a few ways, a handful of ways to cut costs. And the first way will be through laying people off, or you keep your workers and you just buy less inventory, which doesn't make sense, right? Because then, like, if you have less inventory, how are you going to make more money with more employees and less inventory to sell? Prices go up, demand goes down. Simple demand and supply right there, economic stuff. Now let's think about how else this recession risk plays in the part. So we expect lower exports, and with lower exports, you get higher deficits in the current account because we're not bringing in as much as we're giving out. Now, because of that, US companies are expected to make less, lower earnings per share for these US stocks, and that leads to less demand for these stocks, both from people in the US and people, foreign investors, other market participants. Then let's just think about other recession risks for the US dollar. Well, and why stocks really matter. Well, why do earnings per share really matter? Like, come on now. Well, people usually buy US stocks with US dollar, and if they're not buying US stocks, especially these foreign investors, there's less need for them to hold the US dollar. So I hope you got that right there. And then think about the economy actually in a recession and what tends to happen out of that. Well, there are really two things that'll happen: either rates getting cut to stimulate the economy, or literal stimulus being given out to really help the economy. And what does this do? Well, it reduces returns on assets like US treasuries, and also reduces the demand for the dollar, because if there is stimulus or low rates, that drives the demand, that causes inflation. And what loses value due to inflation? For one, the US dollar, because if you just hold $100 and it's been held over the last 100 years, that purchasing power hasn't held up pretty well. I believe it's like 80% it's down in a period of time. So it's really lost its purchasing power, which we just talked about that. And if you want to earn some type of yield on that dollar, you could buy US treasuries and guarantee that fixed rate of return. But the real yield that these treasuries pay once you minus out inflation goes down. So why would I buy treasuries when I could just buy assets like stocks that are going up? So that's great. And what other risks are out there for the US dollar? Well, let's talk about fiscal policy. And this really plays into Trump's big, beautiful deal right now. Now, let's break it down and kind of talk about, let's go in a little bit deeper on all of this. We'll talk a little bit more about bonds and this fiscal policy we just mentioned. Now, the economy has a few different risks right now. And the main risk is the inflation risk. It's causing a lot of uncertainty due to one thing: the big increase in tariffs that we've got since the Trump administration has entered the scene yet again. And the second thing is that, so we got a big increase in tariffs, which increases uncertainty because it makes expected inflation go up. And this fly just keeps on buzzing in here, wants to learn the bottom line down here on the finance. Now, we got these tariffs that is expected to raise inflation. So less people want these treasury bonds I just mentioned. So in order to get people to want to buy treasuries, you raise the yield at which they're paying. So borrowing costs go up. Now there's a second thing in this equation: rise in government borrowing costs from tax and spending. So tax and spending bill that increases the budget deficits by nearly 3.8 trillion over the next decade. So we got some insights onto this. Is from the Congressional Budget Office, the US Congress, and they're expecting that this tax bill that we've got coming in, which GOP lawmakers successfully passed the tax bill through the House, barely passed, a 215 vote versus 214 that weren't in favor. So 215 in favor, 214 not in favor, and now it's headed to the Senate. Still got a long way to go, but it's expected to increase the federal deficit of 3.8 trillion due to tax changes, including extending provisions of the 2017 Tax Act, which includes revenues and outlays for refundable credits. Now, the Congressional Budget Office expects 280 billion in stimulus over the next year, or it contributing 0.9% of GDP, and lower taxes offsets hits from taxes. Not taxes on the tariff impact is what the Congressional Budget Office expects. But think about this: if they're going to increase the national deficit or the federal deficit by 3.8 trillion, what do they have to do? If they're running the deficit even larger and they're not bringing in all that money, they'd have to issue more debt. They got to sell more bonds. And that's happening during bond demand already being weak. And we just talked about how you drive the demand up for something. You'd have to entice you'd have to make it worth their while. And with US Treasuries, the way to make it worth their while to buy more of these bonds is to raise the yield up more, and that inflates borrowing costs. That makes it tighter. That makes the chokehold on the economy tighter because borrowing costs are tighter. And bond demand's already weak for a few different reasons. We just talked about inflation due to these tariffs, and then think about Trump imposing these tariffs on these other countries. Well, they might have a sour face, so to say. I'm kind of salty, Trump. Like, you put tariffs on my country, and that could cause some political dysfunction going on. And think about how yields around the globe have been rising, and with all the mess and political dysfunction and Trump and negotiations still going on and higher yields other places like overseas, that adds to competition, and it doesn't make sense to just buy US treasuries if you're a treasury buyer. You want to kind of diversify away from the US just because all the dust hasn't settled yet. And then think about the Moody's downgrade from AAA to AA. That's just more hay on top of that hay bale getting built, that problem. But now we need more we need more money right now. So despite all of this stuff impacting demand for bonds, making it a little bit weaker than it was, now we need more, and that's bad for bonds. There was this joke I read on one of the articles on the Wall Street Journal or something, and it was talking about how kids will ask for $10, get told no, and then shoot them renegotiate with them. All right, well, how about $20? Like, man, I'm not giving you $10. Why would I give you 20? And they're joking about how, and also to add on to bond demand being weak, we just had a weak 20-year bond auction yesterday, but now they're talking about this tax bill and tariffs and how it's going to increase it's not going to help out with the deficit. Instead, the deficit will increase under this tax bill proposal. And we just had the bad auction and all of this demand's already shown weak and there's reasons why it's weak, but we're going to ask for more money under this tax bill. Now that's bad for bonds and that could be okay for stocks, right? Thinking about stocks, well, stocks could do well if there's inflation, but they're close to all-time highs and then borrowing costs are high and going higher, which would make it harder for companies that are like thinking about weakening their forward guidance expectations and then people lowering their expected rates that these stocks will bring in. Now, what we're seeing in the bond market is what's called a bear steepener. So the 10-year treasury is up to around 4.6%, and it's up since the mention of these fiscal policy proposals out there, and the 30-year treasury jumped up even more to 5.13%. So a bear steepener is when long-dated bonds rise faster than shorter-term bonds, typically echoing concerns of inflation and expectations that the Fed isn't likely to cut rates even if the economy weakens, which is bad news for stocks. And Jamie Dimon mentioned today he doesn't see stagflation off of the table yet, and that risk could be increasing. And it's just a complete mess out there. And then I thought this was funny. So the 30-year treasury yield's jumping more than the 10-year treasury yield, and that's referred to as a bear steepener. And it goes back to Scott Bessent saying he'd keep the 10-year treasury down. Like, that's where he wants his focus right now. So it's like, yeah, the 10-year treasury yield didn't go up, and hey, I told you that was going to be my focus. He really wants to bring it down, but it's not going up as high as the 30-year treasury yield, which is kind of funny in my opinion. Like, all right, that 10-year treasury yield didn't go down. I didn't say nothing about the 30-year. And the 30-year, that's typically where people borrow for real estate, those type of assets. And actually, the real estate sector is one of the few sectors where inflation is proven to be sticky. I got the Consumer Price Index, the CPI release that came out on May 13, 2025. And look at this line I highlighted. It says the index for shelter rose 0.3% in April, accounting for more than half of all the items' monthly increase. And where's real estate on this little chart? Shelter. So shelter's really been proven sticky. Utility, I mean, they usually take utility and food out of the CPI. So you like looking at core inflation, and shelter's included, and that's really where we're seeing a lot of the inflation holding up. So that could be a way to kind of slow demand for real estate and help brings inflation down to the Fed's target. Now we got to remember they don't typically watch CPI. They like watching PCE, but I digress. Now, with all of this happening to the dollar and bonds and the need to issue more bonds while they're already weak in demand, which is in turn bad for US dollar, what does that cause other people to do? Well, that's going to cause foreign market participants and really all market participants out there that are this savvy. And this is a little bit, it took me a while to read through all this and understand, a lot of asking questions and coming back. It's going to cause all of them to flight to safety. And some of these other places they could be going is like gold. And then here, let's see real quick. There's gold. Let's see how gold's doing. Yeah, so gold's really been going up. And it's near all-time highs. And what else is doing pretty well right now? Bitcoin, cryptocurrency, away from the US dollar. Briefly touched 112,000 or really close to it. But wow, all of this is happening as the US is really having trouble and the US dollar is appearing weak. All of that's very interesting. Now, where else are they going to flight to safety? The yen. The yen is an interesting one, and this goes back to, so I wanted to mention that I was reading this article and it was talking about how currency's reserve status have historically lasted a century. And the US's dominance really started around 1944 with Bretton Woods, when 44 countries fixed their exchange rate to the US dollar, which the US dollar was pegged to gold at that time. And then the US dollar severed from gold in 1971 by Richard Nixon. And right now, and we're about to go back into the yen here in a bit. But right now, Trump sees it as overvalued because its world structural bid hollows out American manufacturing and forces the country to run perpetual deficits, according to Dario Perkins, an economist at TS Lombard. So that's what I read from him. And we'll get to the carry trade here in a bit, but I wanted to go back to recession risk for the US dollar weakness. What does that really mean? Well, the Fed cuts rates, it lowers dollar demand because rates are now paying less. Slower economic growth lowers investment inflows. Widening trade deficit lowers the demand for US dollar. Risk of higher debt and stimulus lowers investor confidence, because why are they going to have to do that in the first place? Capital moves to other safe havens, and that lowers the US dollar value. And then I think I went further and said, I think this is it. Why does the US dollar having a high global structural bid hurt the US manufacturing and cause trade deficits? So it talks about how the US dollar is the world currency. Most international trade, oil, and commodities are priced in dollars. This creates permanent demand for dollars as countries, banks, and companies around the world need dollars to trade, invest, and hold in currencies, in reserves. That persistent demand for US dollars keeps the dollar strong, even if when it would otherwise fall due to trade deficits or inflation. Strong US dollar makes US products more expensive. When the US dollar is strong, American made goods become more expensive. Meanwhile, foreign made goods become cheaper in the US. US exports fall. They're too expensive abroad from these other countries' perspectives. US imports rise, so cheaper to buy from China, Mexico, and then American manufacturing as hollows out because domestic factories lose competitiveness because they're not able to price it at what these other countries can price it at. The US ends up with trade deficit, importing far more than it exports. And that goes back to Trump's view. The world loves our strong dollar, but it's killing our factories and workers, and he wants to bring manufacturing back to the US. Who knows how that happens? But why it causes perpetual deficits? Trade deficit, more money flowing out of the country than in. To finance that, the US borrows more from other countries, and that's through bonds, and bonds are weak right now. And then we're stuck in this loop. We're in a deficit, borrow, strengthen dollar more, repeat. Now, how does slowing down the US economy affect other countries? Because that's what we're doing right now, right? Well, demand shock to global exports. The US dollar is the US is the biggest buyer of goods from China, Europe, Mexico, and other countries. If American consumers pull back spending due to job losses, rate hikes, or recession, other countries sell less. This leads to slower GDP growth, job losses, and factory cutbacks abroad. Stronger local currencies. If the US slows and the Fed cuts rates, the US dollar weakens. That makes other countries stronger by comparison, which hurts their export competitiveness. So they lose both volume, less than US demand, and pricing power, stronger currencies. And we talked about all of this. Now, US markets drive global markets. A US slowdown, stock sell-offs, bond flight, and volatility worldwide. Also, many emerging markets borrow in the US dollar. A US dollar slowdown means a weaker dollar can create repayment risk, capital flight, or currency devaluation. And then lastly, supply chain and investment spillovers. US companies pause investments and cut global supplier orders. Global companies that rely on the US for capital investment and business feel the ripple. And it starts really going through the economy slowly, and it could really rattle the US dollar and price. Now, I wanted to talk about this carry trade because I'm a little bit late here, but people are seeing that this could be a furthering issue in that we haven't seen all that we could see out of it. So there was a return home by Japan recently, and this creates competition as the USD to Japan, so this is in US dollar terms on this chart. The Japan's 30-year bond yields have spiked to 3.18%, which is the highest in over 25 years, and this raises interest rates. Now, this is where the yen carry trade came in, and this is a little bit more complex than we're going to go into, but pretty much to sum it up, people borrowed money in yen at low rates, and they buy higher yielding currencies like US dollar to buy these bonds, so US treasuries. Now, imagine money made completely out of thin air because it technically didn't exist, and then it was loaned out at low rates to go buy treasuries that paid better yields, so they were able to make the spread off of that. But it disappears as rates go up because then people sell that and then they pay off the debt and then that money disappears. Well, what we've seen is that when that happened, people sold the US treasuries, which less demand or more supply onto the market, which caused these US treasury yields to spike. And then they went over there to their loans over there in the Japanese yen and like cashed them in, like, all right, I want to pay this off. So that took money out of the system and kind of dampened demand and supply all at the same time. Well, dampened demand and raised supply, which spiked these yields. So all of that was bad for the US dollar, and what we're seeing is another rising gap between the US JPY, so USD compared to yen, and US yields, a sign of rising fiscal risk. The widening gap between the 10-year treasury yield and the yen, which has been appreciating against the dollar, is a sign of rising fiscal risks. So people's worried out there. A lot of reason to be worried. We actually just got, I'll pull it back up over here on the stocks. We got some news today. And some of that news was around business activity rebounds. We got stocks. We got some information on real estate, which existing home sales. And I wanted to start off with Ross. So Ross is this clothing store. A lot of people shop there for clothes. And they beat last year's earnings per share by 1 cent. But quarter profit was down about 9 million. And the reason they were able to beat last year's EPS, really because they made less, was probably primarily towards cost cutting. So if they weren't able to cut costs, they would have been lower than last year's earnings per share. Revenue grew by 3%, so that was a beat, but they mentioned that they had a slower start to spring starting in February. They withdrew its previous full year guidance due to tariff uncertainty, which tariffs would be pressuring profit, and that causes them to expect to reduce earnings per share by 11 to 16 cents. And this is primarily because more than half of what Ross sells is made in China. And they pointed out the fact that, well, some economists pointed out the fact that Ross attracts lower income customers. And they're most impacted by inflation already. But tariffs threaten to raise the costs of imports through a tax. So that raises the costs of goods even more. And that causes more comps out there as far as what clothing and shoes costs, and lowers demand, which, all right, so there's lower demand and more comps, so people are pricing more competitively. Could we start seeing deflation in these clothing and shoe sectors? Which that would mean a strengthening US dollar. But let's talk about business activity, because right now it hasn't been too bad lately. Business confidence has improved. Just a little bit it's improved, but it's improved, and that's thanks to that pause for higher tariff rates. Now, just for context, a reading above 50 signals expansion on Purchasing Managers Index. So PMI for manufacturing and services both rose to 52.3% from its 19-month low of 50.6. And this shows that there is expansion right now, and that's good news. And services output prices index jumped to 2-year high of 58.5, a sign of inflation due to tariffs. And Pantheon Macroeconomics said that a softening labor market will serve to slow wage growth, balancing out higher costs of imported goods and services inflation. Now, despite the rise, export orders continued to fall and supply chains delays intensified. Now, as long as this stuff keeps on slowing down, like business activity looked good. But if we see lower job numbers and then supply shocks, that could really start getting things pretty weird. So there's good news out there, there's bad news. Somebody even thinks that we can avoid a recession assuming that um, that these Trump fiscal policies being proposed will, cutting taxes that would cause economic growth and expansion. And because of that, that would lead to more money being put into the economy and then no recession at all. And stocks doing well, they're up near almost all-time highs again. So that would all lead to economic expansion and be good news and could be what drives us from ever going into a recession. Now, we're going to keep on watching that and see how all of that goes. But now I wanted to talk about existing home sales because that's what we mentioned where the sticky inflation is really happening, well, at least happened in the past, and it could keep on going. It's a seller's market right now, but existing home sales have fell for the second straight month in a row. They fell by 0.5% in April to 4 million, and that's the slowest pace for any April since 2009 according to the National Association of Realtors. That's over 16 years. Now, sales fell 2% from a year earlier. Median sales price rose to 414,000, and that's a record for any April, up 1.8%. Now, in combination with these mortgage rates, which we're expecting to keep on going up as long as there's this bond drama, the prices, once you include high rates due to this bond drama and then high median sales price, so homes are still appreciating in value, that's a little too high for borrowers out there. Like if you're paying cash, like, yeah, you might have a little bit more wiggle room, but if you're a buyer right now and you got to borrow, it's pretty tough. It's pretty tough. Now, the markets where we're seeing home prices decline and inventory really start building will be more of your southern markets, but in the Northeast and the Midwest, supply is actually down and prices are still going up. So inflation could be sticky in the Midwest, which is where I live. You got to really know how to navigate this market. It's a funny time, y'all. We also seen advanced auto parts up 57% today. And I was looking through the report and they said it's really not due to any fundamental factors. It's just because the company had a float of a short of the 17 float of the company's stock or something. I barely brushed through it, but yeah, because it that company's not doing too well is where it put. So this is a really interesting time out there altogether. The US dollar struggling, and the Trump administration wanted to bring it down, and that really helps them negotiate tariff wise, I guess, because slow the US dollar down. Because what they say, how they put it. Let me find it real quick. Let me go back. Trump sees it as overvalued because it's world structural bid. So the bid for the dollar hollows out American manufacturing and forces the country to run deficits. So then if the purchasing power is a little bit weaker, people buy less. Then on top of that, like inflation was already an issue, borrowing costs are high. It really slows down like the global economy. And then right when everybody's slow, that's when like Trump kicks his feet on the desk and he's like, all right, let's talk. I don't know if that's how it happens or not, but it's just trying to learn and connect my dots. Like I'm still a rookie here. I'm still learning. But like there's like clicks here and there, and some of it makes sense, some of it doesn't. But this one kind of makes sense. Like issue tariffs and lower demand, and then like it's already tough out there for the consumer, and then try to negotiate when everybody's at their worst. But it just kind of takes this period, and he said it in an interview before. Hold on, let's see if I can find it real quick. See if I could find it. And then we'll end the video off right there. Come on, you load. Oh yeah, it was NBC, YouTube. Come on. All right, it's right there. I promise. I'm gonna exit out some of these tabs. Maybe that'll load it. Oh yeah, here we go. Ah, yo, we gotta see it. We gotta see it.
Some people on Wall Street have expressed concerns that the possibility of a recession is increasing. And I want to know what you think about that. Are you comfortable with the country potentially dipping into a recession for a period of time if you are able to achieve your long-term goals?
Well, you say some people on Wall Street say, well, I tell you something else. Some people on Wall Street say that we're going to have the greatest economy in history. Why don't you talk about them? Because some people on Wall Street say this is the greatest.
Well, that's what I'm getting at. That's what I'm getting at, though. It's the same question.
Yeah, there are many people on Wall Street say this is going to be the greatest windfall ever happened.
And that's my question.
Remember this.
Long term. Yeah. Is it okay in the short term to have a recession?
This. Look, everything's okay. What we are, I said, this is a transition period. I think we're going to do fantastically.
Thanks for watching. Stay updated about breaking news and top stories on the NBC News app.
There's just this transitionary period. Nobody knows recessions like I know recessions.